Hello and welcome to the City Traders Imperium Starter course. So in this part we're going to be looking at styles of trading, more specifically styles of analysis in trading. So when you come to the charts, when you actually start trading FX, there are multiple ways of doing so, multiple styles. So let's go through now and take a look at those. And as we're going through, try and think to yourself what might be the ideal one for you, depending on your situation, your commitments, your work schedule, etc. And also your personality also comes into this quite a lot. So let's start off then with the styles of analysis in Forex. Now, there are three core styles, but you have to keep in mind that elements of these styles can overlap. So it's not like you have to stick to one specific style. Me, for example, I have a combination of two of these, and you'll probably find that most people do. Very rarely will you have just one specific style and that's it. There's very, very often these overlaps. So starting off then, technical styles of analysis. Now, a technical style is purely based on charts. Now, when you open a chart, we'll look at this a bit later, is things like candlestick analysis, wave analysis, all the different technical analysis tools like trend lines, ranges, channels. It's a very broad range of things. And again, there's going to be some people who use some of those and don't use others, or some people that use all of those. And it's all just going to be based purely on the charts. So all the information you gain on where the currency, the exchange rate may go, you don't look at the news, for example, you don't do something called algorithmic trading, which we'll also look at. We're using robots to make decisions for you. You're clearly just looking at the patterns on the chart. And because of that, you have to be using the past to predict the future. Because you're not looking at current events like with the news. So you're having to say, right, this pattern worked many years prior, so it's been working for some time before, and therefore I expect that this has a higher than 50% probability of working in the future, and therefore you're making those decisions of your trading based on that. Now, you can also use, on top of just a plain chart, indicators and technical tools. So those are the ones that I said before, like the channels, ranges, all things that may not make sense to you right now, but we'll do later as we go through the course. And indicators such as stochastics, RSI, etc., etc. So all of these things can aid you in your decisions, and of course you're going to find out which ones work for you over time, and different strategies will utilize different ones, and it's all just really down to the individual. Secondly, we have fundamental, and what fundamental means, and we do have a chapter on this later, is looking at news and current events. So it's basically looking at how the macroeconomic picture of things is influencing the markets or can influence the markets. So what macroeconomic means is the economy of the world as a whole. So you may be looking at something like how the Bank of England is changing their their interest rate, or perhaps how they're changing quantitative easing. So the monetary policy tools that the banks are using have a huge influence on the direction in the exchange rate of currencies. Maybe there's a big natural disaster in, let's say, Japan or something, and that causes an incident which could knock onto a market like a commodity market. Or if there's a drought, let's say, and that affects wheat markets, you can literally trade anything. Well, that's looking at the fundamental drivers of where that may go. Whereas if you're a purely technical trader, you would get all the information from the chart. So you would see the chart start to go down, certain pattern forming you may want to get in. And then some people may combine the two. So they're looking at the charts for entries and things like that, but they're understanding the fundamental picture and studying the data points, like economic data points, in order to form a macro view of the instrument that you're trading. And finally here we have algorithmic. So algorithmic is a purely mathematical based way of trading because you're using robots, algorithms, these are like mathematical formulas that program a strategy that works by itself. So you may have heard the term high frequency trading before. So when you have participants entering and exiting the market extremely quickly to try and catch a small profit or front run people, etc. This is all done algorithmically. Now you can also have automated trading strategies. It doesn't have to be super small time frame, but these can also be run algorithmically with robots, etc. that do the trading for you. This isn't very accessible to the average retail trader because you'll find these hedge funds and financial institutions, they will pay vast sums of money and hire top mathematical and physics graduates from the top universities to program these robots for them, these algorithms, and they're not really very easy to program for yourself. So it may sound awesome, you have a robot that just makes money for you, you don't have to do anything, but it's a lot of work that goes into it. And therefore most retail traders will go the technical route with some understanding of fundamentals, and maybe further down the line, they may incorporate some algorithmic stuff in there too. So those are the 3 different styles of analysis. Now the styles of actually trading it then, let's have a look at the 2 ways of trading. Now these 2 core styles are based on time. This will make sense in a second. So the first one is intraday. Now intraday is also known as day trading, and a lot of you are probably familiar with that term. You see it in the news quite often. So day trading is executing trades, one or more than one, within one 24-hour period. So essentially you are coming to the charts as you would like go to your job, for example. You're taking trades, you're doing your work, and therefore you're opening and closing multiple trades within the day. And then let's say it comes to 8 p.m. in the evening, you finish for the day, go to sleep, wake up the next day, and you start day trading again. So you're not really holding positions overnight. You're not holding those positions for multiple days in a row. Now, of course, there's pros and cons to all of these different things. Now, it does require more time spent at the charts because you're having to actively trade, and like sit there and trade, actively analyze as the market's moving, managing those open trades. You're going to have likely quite a lot of opportunities, which can obviously be a good thing and a bad thing, but it's going to be a lot more active, a lot more involved, and therefore take up more time. So if you're someone who has lots of commitments, let's say you've got a newborn baby and you've not got much time, or you have a full-time job and you're working from 6 in the morning until 5 in the afternoon, it's going to be virtually impossible for you to day trade because you can't do that alongside like serious commitments or a very busy work schedule. So therefore something that might be better for you, or like again, a little kind of combination of the 2, is intraday. So intraday is between days, so it's swing trading. Now, this is when you can execute a trade that lasts for longer than 24 hours. So let's say you open a trade on a Monday morning and you expect to maybe hold that until Wednesday afternoon. You don't really know when you will get out, but let's say you end up holding that for 2-3 days. That's not a day trade because it's not been open and closed in the same session, so to speak. So therefore you're swing trading, you're intraday trading, and that trade is lasting for more than 24 hours. Now, it's less intense in a way because you don't have to spend all day at the charts, but then you're probably going to have less opportunities, but that's going to be mitigated by bigger, what's called risk-reward ratios, etc., which we can look at later. But really, this is a style of analysis better suited, or a style of trading better suited to those with busier work-life sort of like balances, basically. So of course, many people, again, like myself, have a bit of a hybrid between these 2, more kind of swinging towards the intraday, but I still do intraday as well. It's unlikely you'll only do one or the other, but you'll find your own style as you get through. Now, the last 2 core styles are based on the approach to doing it. Now, these 2 approaches, the first one is discretionary. Discretionary is when there's more choice involved in what you're doing. So if you think back to the algorithmic stuff, right, where it's based on a mathematical formula, based on rules that are programmed into the system, that's not very discretionary because you don't really have much choice over what's happening there. Of course, you can choose when you write the code, but once you've actually start running that robot, you run that program, you don't have any choice in what it's doing. It's just running off the code that you write. So therefore, if you come to the markets and something happens and it doesn't like line up with the code, let's say there's like a massive news event that comes out and really the robot shouldn't be trading, but it can't know that news is going to happen. Therefore, it's not being discretionary. It doesn't have a choice. It just does what it's going to do. If you have a discretionary strategy, you're making your series of decisions more on your own intuition. So you'll have a strategy, you'll know roughly what you want to see, but there's going to be lots of depending variable factors. So therefore, you have to use your own discretion as to whether you take that trade or not, or how you manage it, how you enter, how you exit, which won't necessarily be the case for more what's called mechanical ways of trading. Of course, the left-hand side of the discretionary, you are going to require a lot more experience and mastery of your own psychology. Because if you're very, very up and down with the way you think, or you don't have a rock-solid risk management psychology in the markets, your decision-making is probably not going to be serving your best trading interests because you don't have that experience, or you haven't learned the best way to do that. And if you have like a really strong gambling personality or something, discretion is probably not going to work in your favor until you've learned how to actually turn that around. So the mechanical is going to be more like algorithmic, a lot more rule-based, and therefore a lot of your discretionary decision making is mostly removed because you have a rule set. So you can have a checklist of exactly what you need to see, and if anything deviates from that at all, then you just don't take it. So you wait for certain indicators to do certain things, in a certain time of day. There's unlimited possibilities, but it's obviously not a discretionary approach. Now, it doesn't require as much, it still requires experience, but it doesn't require as much mastery of psychology because the program or the rules are doing the trading for you. But therefore, if that's the case, you have to be very, very certain that your mechanical strategy, when you go back and you look at, let's say, the previous year of data, if that mechanical robot doesn't make money, doesn't make a profit, then there's not much point in using it. So you have to know that when you back test that strategy, it's actually making money. So it requires that extensive back testing, ensuring the rules that are being used are profitable over that longer time period. Choosing your style. So what should you do, right? If you're brand new to trading, if you've only got a little bit of experience, you might be thinking, well, there's quite a few different options there, so which one should I do? There's no right or wrong answer to it. So every style of analysis and every style of trading, as I said before, isn't in its own box necessarily. You can sort of like use elements from each of them, and you will find over time as you trade and you find your own way of your own strategy, or you learn from someone else's strategy, you will then start to work your way into one of those boxes, but every now and again you reach out and pick something from another box, so to speak. And there is no right or wrong way to do it. There can be 10 different strategies using all those different types, and they can all make money, or all lose money, of course. And you're going to try a lot of styles. So unless you go head on and learn from someone and just learn their strategy, then of course you'll be inducted into one way of trading. But a lot of people, especially if you're coming here after trying to trade for like multiple years or something, then you're going to probably hop from strategy to strategy and different styles. And some people will mold their own hybrid combination if they create their own strategy. But at the end of the day, experience will tell you what style to choose. Because if you try and trade discretionary, day trading, all that sort of stuff, and you're working 10 hours a day anyway, experience will probably tell you that's not the best way to go. So you may have to switch that style up slightly and do something a bit different in order to manage to actually trade properly with all those commitments. And just to end here, this is a great little quote from a guy called Yvon Biaggi. I think that's how you pronounce it. Trading doesn't just reveal your character, it also builds it if you stay in the game long enough. So if you just commit, you actually get involved, you're going to have trials and tribulations along the way. You'll find something doesn't work for you, does work for you, and it will build your character over time, build your style over time, if you stay in the game long enough. So it's that sort of meme of the guy digging for diamonds, and he turns around just as he's about to approach them. If you just keep going, you will find a way that works for you, and trading itself will build, or experience itself will build your character.